All right, welcome to the Explainer. We're going to jump right into the latest weekly report from Moffitt Securities because we really need to get a handle on what's going on with the Iranian capital market right now.
The whole market is kind of stuck at this weird crossroads. It's a real tug of war. On one side, you've got these valuations that look, honestly, pretty darn cheap. But on the other side, there's this massive sense of caution just holding everyone back.
So that's the big question we're trying to answer today, right? In a situation like this, packed with risk, where do you even begin to look for opportunities? Is all this fear just noise, or is it a real signal? Let's dive in and see.
Okay, so Section 1, a market under pressure. Let's start by taking the market's pulse, What are the big, high-level numbers telling us about what's really going on?
So let's start with a classic, the P/E ratio, the price to earnings. Right now, the market's sitting at a P/E of 7.8. Now, if you look back at the historical average over the last 10 years, that number is 8.6. So what does that tell you? Plain and simple, the market looks cheap compared to where it's been.
Which, of course, leads to the big question. If everything looks so cheap, why aren't investors just piling in? Normally, a discount like this would be a buying signal, but that's not what's happening. So what's really going on? Well, look no further than the trading volume. This tells a huge part of the story. The average daily trading volume just fell off a cliff, going from 15,000 billion Tomon down to 11,200 last week. That's a big drop. It's a flashing sign that people are hesitant and new money is staying on the sidelines. And the Moffitt report really drills down into three main reasons for this, these big headwinds. You've got geopolitical risks hanging over everything, creating uncertainty. Then there's this very real problem of energy instability. We're talking potential power outages that could cripple industrial companies. And of course, the one we just saw, the falling trading volumes, which just makes it harder for everyone. Okay, so to really get our heads around these huge macro risks, sometimes it's best to zoom way, way in. We're going to look at a case study. One company, Fajar Energy, its ticker is BFAJAR, to see how all this big picture stuff actually impacts a single business. So who is BFAJAR? Well, you can think of them as the life support system for Iran's massive petrochemical industry in the Mahashar region. They provide the absolute must-haves, the power, the steam, the oxygen, all the critical stuff that the huge players need to even turn their lights on. They're literally the power plant for the whole operation.
And here's where it gets really interesting. Look at their customers: Arvind, Murun, Shahzand, Torndaguzian. Just those four companies make up almost all of their business. I mean, over 3/4 of their sales. This tells you that BFAJAR's fate is completely tied to the health of these few giants. If they do well, BFAJAR does well. If they stumble, well, you get the idea. All right, so let's get into how BFAJAR actually gets paid, because this is not your typical business model. It's not just about sending an invoice for services. Their entire profit structure is built around a really unique formula, and we've got to understand it. Okay, so check this out. It's designed to be symbiotic. BFAJAR gives its customers the utilities they need, right? But what they get paid isn't a fixed price. No, it's based on a formula that is directly linked to how profitable their customers are. It's brilliant, really. If the petrochemical giants are making a lot of money, BFAJAR makes more money. It's a true we're in this together model. And the report itself puts it perfectly, saying the goal of this formula is to align the profit-making of the utility producer and consumers. It's all about alignment. It's not just a transaction, it's a partnership. But, and this is a big but, it also means that all the risks their customers face, BFAJAR feels them too. Okay, so that's the revenue side. What about the costs? I mean, take a look at this chart. It's wild. Production overhead is nearly 90% of their entire cost of goods sold. That's massive. It just dwarfs everything else. So you have to ask, what on earth is in that overhead? And the answer is the linchpin to this entire story: natural gas. That is their single biggest cost. Their whole profitability hinges on the price and, maybe more importantly, the availability of natural gas.
And boom, just like that, our deep dive into one company brings us right back to that huge market-wide problem of energy instability we talked about earlier. So, now we've seen how a big picture risk can hammer a single company. Let's pull the lens back out again and look at the whole economic landscape. How does this one company's story fit into the bigger picture? And here's the backdrop for everyone. Inflation. The latest point-to-point rate is 38.7%. A number that high, it puts a squeeze on everything. It hits what people can afford to buy, it makes borrowing money more expensive, and it puts the central bank in a really tough spot. And speaking of the central bank, you can see they've really been shifting gears. If you look back, they were in an expansionary mode, trying to stimulate things. But more recently, they've slammed on the brakes, moving to a contractionary or tighter policy to fight that inflation. And that's only gotten more intense this year. In simple terms, money is getting tighter, which could slow the whole economy down. And this is why we went so deep on Bafajar. Its story is the market's story, just in miniature. You see a company totally dependent on its customer success, getting squeezed by national energy problems, and all of it happening inside this bigger economic storm. What's happening to them is happening to so many others. Okay, so we've gone from the 30,000-foot view down to a single company and back out again. So what does this all mean for you, the investor? What are the key takeaways here? It all comes back to that tug of war we started with. On one side of the rope, you've got these powerful headwinds pulling everything down, energy issues, no new money coming in, and just general uncertainty. But pulling on the other side, you have some serious tailwinds. Valuations are low, there's a chance some of these big risks could get better, and you've got the potential for a really sharp rebound if and when things turn around. So, if you're trying to figure out which way this rope is going to go, here's your watch list. Number 1, anything to do with natural gas pricing. That is huge. Number 2, watch those daily trading volumes like a hawk. When they start to pick up for real, that's a huge sign of confidence returning. Number 3, keep an eye on how the big petrochemical companies are doing. They're like a canary in a coal mine. And finally, of course, what does the central bank do next? And so that leaves us right back where we started, with one final massive question. You've got these very real, very clear risks staring you in the face, but at the same time, you've got this potential for real value. So is all the fear you're seeing in the market a sign to run for the hills? Or is it the exact ingredient that creates a once-in-a-while opportunity? That really is the question everyone has to answer for themselves.